Edison Byzyka is joining as the Chief Investment Officer at Credent Wealth Management. Edison, good to have you back on the show as well. I want to talk a little bit here, kind of following up the conversation we just had. If there's no trade updates, what does this market do? It seems like everything is basically tied to the tweets, to the rumors, to the stories out of both sides. I mean, what's the path of least resistance in the absence of trade information?
Well, the most ideal thing that should happen is, first of all, that shift back to fundamentals in this case, which hopefully see rising yields a little bit and higher equity prices. Because if you kind of take that uncertainty out, right, and uncertainty is the key word that keeps being brought up by every portfolio manager and every analyst out there. And unfortunately, that's not going to go away. With that in mind, I would hope that in such an environment, right, well, maybe we go tweetless or any news maybe for a week or two, that we do see the fundamentals rise back in, where we see that breadth in the S&P 500 rise again. Things look very strong on that front, and we see yields kind of pop slightly higher, which should be the right thing to see here, hopefully this week and next week as well.
Yeah, it's interesting on your notes, basically pointing out that right now, if you look at breadth, it's kind of mixed, right? Indicating upside is same chance as downside. Even after last week, participation in the market did improve a little bit from the week before, but actually we've got a whole lot of kind of neutral signs. If we look at some of the indicators I looked at this morning, Edison, you've got the number of companies making new 50-week highs is pretty muted, right? The number of stocks that are oversold or overbought is basically like 0%. Nothing is on an extreme. We do have some strength with companies above their short-term moving averages, but it looks like this market could pick up some momentum, right? Even after last week's sharp gains on trade, there's still a lot of companies that aren't in really elevated position.
Excellent point. Yes, I fundamentally believe that. And let me tell you this, Oliver, when you look at the data on an S&P 500 ex-tech basis, it looks even better. So if you kind of extract some of those high gainers for the year and some of the potentially overvalued individual equities, the market's breadth at that point stands at a much, much better place. I think any catalyst to the upside, whether it be any potential hopes for a trade war, a de-escalation, or whether we're looking at some better labor data, whatever the case may be, tomorrow's retail sales announcement, which I'm really looking forward to, I think could be that certain catalyst to maybe push that breadth a little higher in the absence of any bombshells that may come out this morning or later this week.
Edison, is there a requirement then for this type of rotation that you describe, higher yields and a little bit of value-oriented leadership? Last week what we saw were industrials, materials, very specifically semiconductors, the more cyclical side of tech that's been outperforming high valuation software since September. For that type of leadership to maintain, do we need to see big beats on some of the numbers this week? Do we need to hear from the Fed speakers, and there's a lot of them this week, that maybe they don't need to cut all the way down, that the economy's not, falling apart? How does that trade continue if we've got a whole host of Fed speakers that are probably going to want to still keep the door open to cuts?
So we have a couple of manufacturing announcements this week, and we have key retail sales tomorrow, and we have housing starts as well. I think for that leadership of last week to maintain for this week, we will need to see some good fundamental backdrop there on that economic data point. Now, that aside,
yeah.
Go ahead.
No, go ahead, Edison.
So that aside, to kind of see how things may shift to more value leadership as opposed to more of the cyclical leadership from last week, I think if we get any sort of indication from the Fed that the future guidance is maybe a little more foggy, as opposed to say how the ECB has made it significantly clear on what they're going to do. The Fed hasn't truly done that yet, but even talking about how the latest QE isn't really QE. They're trying to kind of get away from that true forward guidance on monetary policy. I think that will be the key. If we see that this week from these Fed speakers, that will be the key that will allow, I think, value to outpace growth here in the short term, as that is a kind of a lower beta trade on the part of investors that do think equity market participation makes sense, but maybe not to the fullest degree that, say, growth has been acting in over the past year or so.
This is a really interesting point. Two things here. Number one, Scott, because I think this is really important as we set up this week to find out if the kind of reflationary leadership that we've seen around trade optimism, if it holds. The offset to that last week, we got the Fed saying they're going to continue to support the repo markets. To your point, the not QE or QE debate, but it seems like whether or not we can argue that all day, and I know there's very strong opinions on both sides of the aisle, it seems the market is not really treating it as the kind of QE playbook, right? We're not getting that kind of big growth leadership yet, but if we continue to hear about support from the Fed, does that basically help growth, help the low rate kind of playbook we've had for so many years as opposed to this reflationary turn?
So I'm not sure it does. And the reason for that is because if I look at the last rate cut, when the Fed cut rates, three things happened. We saw yields spike slightly higher. You had the dollar move higher, and you had equity markets move lower. All things indicative of a non-rate cut environment. So I think this Fed's QE play, I find it very hard to believe that that in itself is going to actually boost risk assets. It may prolong the short-term borrowing environment in the short term, helping the housing market maybe a little bit longer. But as far as helping risk assets from those actions, I don't think that's going to happen. What is going to be that catalyst, again, is that promise for true forward guidance to push rates even lower. I think that means a lot more to the market than their actual actions that they're taking right now. And that would resemble what's been happening with Mario Draghi and the ECB. I think investors in the U.S. are looking for that.
Yeah, really good point. Really important distinction, I think. The secondary point to this then is a market where the leadership comes from some of the less favored groups over the last, basically decade. Because when we're talking industrial leadership over high valuation growth, and that's pretty much what we've seen here for a decent amount of time now. Basically since September, it's gotten a little bit murkier. Is there a backdrop in that scenario that's as bullish for the overall market, or is this going to become a more kind of sideways chop if the high, big tech names that were the leaders for so long take a back seat? Is a value-driven market as positive for the overall level of the S&P 500?
I think so, absolutely. And it's not just the S&P 500 at that point. Mid caps and small caps, there's the same story. But looking at just the S&P 500, to your point, I think that upside in breadth through the value equities has a tremendous, tremendous potential, given the vastly cheap valuations in that space and the breadth that there's upside there for sure. On the notion of tech, you brought up a good point there that tech leadership can have a significant play here in the markets. I think if we start to see tech deteriorate, and mind you, look at Netflix, what's happened to Netflix volatility even over the past year. As we see that to deteriorate, that equity beta in the market is becoming slightly more subdued, and flows by themselves, by nature, are favoring that value segment. So I think upside in the S&P 500 from the value sector is very possible. I think it can push the entire index higher because the tech space, you have 6 or 7 names, even on a market cap weighted basis, that are dragging a lot of that risk profile of the S&P 500. You remove those or you dilute those a little bit, which I think is likely to happen, especially as potentially rates rise higher, our internal view. I think at that point you see value dominate in a very fundamentally driven way, as opposed to into a scared rally kind of notion.
All right, really interesting stuff. Really good analysis here, Edison. An excellent addition to our conversation this morning. We're going to be watching that performance value versus growth this week in a big way. Edison Byzyka, smart analysis here too.